Hey guys, welcome back to the channel. Mark Casser here. Today we're going to talk about the Kyle Busch versus Pacific Life crisis, catastrophe, debacle, scandal that's taking place right now. If you don't know, there's been a big national response to a lawsuit that has been put up against PacLife. Now, PacLife, if you don't know, is a nationally known life insurance carrier. They're not agents, they're the carrier. They're the ones that give the insurance to the client. And they're one of the bigger IUL carriers on the market right now. And the agent that was working for PacLife was misrepresenting a product that PacLife was offering. And there's a lot to it with lack of oversight, misrepresentation, not well designed, but we'll get into some of the nitty gritty in just a second. I want to make this disclaimer. Okay. Number one, this is not financial advice. This is just a YouTube video. So please do your own due diligence. Make sure you do your own research and you speak to a qualified professional that is going to give you the right answers and lead you the right way. Always work with a fiduciary that designs policies with minimum death benefits for maximum cash value growth. That ensures that the commission is the lowest, the fees are the lowest inside the policy, so that your money goes to the right places and does what it's supposed to do inside these policies. With that being said, I've designed a lot of these policies in the past. I've seen a lot of wrongly designed policies when clients bring me their old policies and say, hey, look what I got a few years ago. And I just shake my head because I can pinpoint exactly where the agent went wrong and did something in their best interest versus the interest of the client. A lot of times, agents are not properly trained and they're only trained in one way to design a policy, and that's with puffed up death benefits, which in turn puffs up the commission and basically causes the policy to be inefficient in what it's supposed to do. These types of cash value policies can be a great tool if properly designed. And if you work with a professional, like I said in the beginning, the lower the death benefit means the lower the internal cost of insurance, the lower the fees, the lower the commission for the agent. And then your money more goes into the cash value, which then is pegged to the stock market. And then it gets a higher rate of return. Now, important to know, these policies are not investment products. They should never be positioned as investment products. They should never be marketed as an alternative to a 401k or an IRA or an investment directly in the market. And agents that do that and boldly proclaim that an IUL will outperform a 401k or an IRA any day of the week and 3 times on Sunday should probably have their license taken away. Now, if it's a one-off and then they get corrected and then they do it the right way after that, whole different story. They have some coaching. But I've seen way too many agents online claim that these are the best investment products known to man because they have a 0% floor, which prevents your money from going down if the market crashes, and they have unlimited gains. The truth is, these policies don't have unlimited gains. They have caps and they have floors and they have participation rates. And that's why they're a little bit more advanced than your traditional whole life, your traditional term insurance. When you're dealing with an advanced market product like an IUL, you have to know what the caps are. You have to know what the participation rates are, the floor is. You have to know about the different indices that each individual carrier is marketing and is offering. I had personal policies that I've set up that after a few years, I look at it and the growth is almost insignificant. It's not doing anything. That's because I had it pegged to the wrong indices that really wasn't doing well. And so with a couple different changes, I've been able to get my policies to an average of 6 to 8% on an annual basis. And I go back to all my clients and I make sure that they know, hey, there's different allocations that you can put your policies to. I recommend doing this versus this because of my own personal experiences. So that being said, guys, if you have a policy, you'd like for us to audit it, you'd like for us to review it, you'd like for us to at least give you an open, honest opinion, click the link down below, schedule a free strategy call. Myself or a member of my team will sit down with you. We'll audit your policy. We'll give you some recommendations. And at the very end of the day, if it's a better fit for you and it's more suitable for you to have a new policy designed for you and it works out to your advantage, we can help you with that. We never want to put you in something that's not going to be suitable for you. So make sure you do reach out and you do give us a call. if that's the case. Now, back to the story. The agent that was representing PacLife in this circumstance did a few things. We'll go through some of the court documents. I summarized it. We read through the whole thing. We have some of the key points that we want to share with you. And one of the biggest red flags inside of this policy that, again, these are allegations that the agent did, innocent until proven guilty. We don't know the full truth. But one of the allegations was there was false promises of final funding. The agent allegedly said to Kyle and his family, if they fund this policy with a certain amount of money for a certain period of time, that they could stop funding the policy and the policy would pay for itself. Now, there's truth to that. Again, if the policy is designed the right way, the rate of return and the cash value growth inside the policy will end up paying for the additional cost of insurance and the expenses in the policy, and you'll out earn what you're paying. Therefore, your cash value will continue to grow. The problem is, if the policy is not designed properly and there's too much death benefits and the cost of insurance inside the policy is too high and the expense charges are way too high and the cash value is not growing fast enough, you see the problem there. There's more fees than there is growth in the policy. And eventually the fees can start to eat into the growth and will end up lapsing the policy. Now, again, we don't have the details and the exact numbers inside of the policy and what the policy actually was designed for and how it was designed, but we're just going based off of these allegations. So false promises of final funding. Apparently, after a few years, they were promised that they can stop funding the policies, and then they get a notice from PacLife that they were due additional premium or their policy would lapse. Now, again, if that's the case, and if that comes out to be the truth, then that means the agent botched the policy design and completely structured it the wrong way. These types of policies are not supposed to require additional premium later on as long as they're designed properly and they're managed the right way. The second allegation was that the policy was designed for commission versus cash value growth. Now, there are certain ways that these policies can be designed. Now, this may bring new regulation to the scene. This may bring new policies and procedures to the scene, which I think could end up being a good thing on how these policies are designed. In my opinion, I don't think they should be allowed to be improperly designed. I think there should be guardrails put in place so that errors, red flags go off during the illustration process so the agent knows, hey, this is not going to work for the client. And I think those guardrails should be tightened up a little bit. The allegation is that the policy was designed for commission versus the mission. We have a motto in our firm, mission over commission always. Even if you earn hundreds of dollars less in commission than the average agent, it's better to put the client in the best position than to put more money in your pocket. And if we ever see our agents designing policies for commission versus the mission, they're gone from our team immediately. So again, we don't know the details, whether this agent actually did increase the death benefits to increase the commission, therefore essentially imploding the policy. But that is what the allegations are, that the policy was designed more for commissions than it was for cash value growth. Now, again, the third time I'm going to say this, if you have an IUL, it's supposed to be designed for lower death benefits so that your cash accumulation will grow a little faster. It reduces everything. Internal fees, cost of insurance, commission to the agent will go down when the death benefit goes down and the cash value growth will go up. That's just part of the puzzle, because then we have the different indices and the intricacies of all the different things that you can add riders and take away riders, and there's a lot to it. So again, make sure you sit with a fiduciary and a professional. The third allegation was death benefit manipulation. Now, you can design an IUL two different ways. Option A, with a level death benefit, which means the cost of insurance stays the same, or option B, with an increasing death benefit, which means the death benefit goes up little by little every single year till a certain period of time, which then it should be switched back over to level so that the cost of insurance starts to decrease as the cash value goes up. Okay. Now, in my experience, when designing a policy with option B, the illustration software will typically lower the death benefits automatically. For instance, If I have a policy that's 250,000 at level, but I go ahead and turn it over to option B with a minimum death benefit, maximum cash value strategy selected, the software will automatically push the death benefit down further than I originally had it level death benefits. Now, that's just in my experience. You can manually override it, especially if you want to put more money in the very beginning of the policy and then structure it a little differently years later. But in my opinion, when you design it with option B, typically the death benefit is even lower than it is with level death benefits. So again, we don't know how this agent designed it or if he manually override the system, but that's in my experience. That's how it typically works. Again, this is coming from a lawyer. This is coming from their law office. They're trying to find every angle to pin against this agent. But I'm just telling you from personal experiences, typically when you choose option B, the software should, in most cases, lower the death benefit so you can achieve your minimum death benefit, maximum cash value strategy. Now, this policy allegedly was only 4 years old, maybe 5 years old. The lawyers are alleging that the agent designed it for increasing death benefits, option B, but never switched it over to level death benefit. Therefore, the cost of insurance superseded the growth inside the policy, and it caused the policy to collapse. There's a lot to that. It's a good design to do option B when the client's a little younger, the cost of insurance is a little lower, so that they can fit more money inside the policy over a certain period of time. That's typically the way we design IULs, with increasing death benefit up to a certain age, and then we turn it over to level, which means the cost of insurance starts to decrease as the cash value goes up. It's a shifting of risk. And that's a whole nother video we can get into that. Now, because this policy was only 4 or 5 years old, it wouldn't make sense for the policy to go increasing to level in the first year. So there's some things that we don't know when it comes to the design and the structure of this policy, but the law office is saying that it was designed improperly. Now, let's just talk about the elephant in the room. The law office, they're lawyers. They probably never took an insurance exam. They probably never got their license. They probably have never seen or messed around with the design of an IUL policy. They've never been trained on how to do it properly. So they're going off of maybe hearsay. They're going off of what maybe some financial advisors say. Maybe they're going off of what Dave Ramsey says. We don't know. But we do know that they're saying in the lawsuit that the agent designed it improperly by giving it an increasing death benefit and not switching it over in time. Now, technically, if designed properly, you shouldn't switch it over for a few years until the last payment of premium. Now, at the 4th or 5th year, if it wasn't switched over, that's a whole different story. Then it could be somewhat the fault of the agent or the carrier for not making the client aware that this needed to take place. It is important to mention that if you have an increasing policy, option B, it is the agent or the client's responsibility to switch it back to level. It will not happen automatically in most cases. Number 3, allegedly the agent did a 1035 exchange into the policy years after the policy started. This to me is a big red flag because you're not supposed to do an internal transfer, an infusion of capital going into a policy after the policy started. If you're going to do a 1035 exchange, which means you take cash value from another policy and you move it into an existing policy, you should do it at the inception of the policy. It should never be done later for many reasons, one of them being that the surrender period resets once new money is added into the account like that. And when the surrender period resets, that means expense charges, internal cost of insurance goes up again, and the policy basically starts over from scratch, and it is a commissionable event. So, that being said, if this is true, the agent did receive an enormous amount of commission all over it. Now, there is a MEC limit that should have been set in the very beginning, and the client and the agent should have known that they were not able to put in too much money or else it would become a modified endowment contract. This leads me to believe that the agent could have puffed up the death benefits to the place where they did have enough room to infuse the policy with additional premium several years down the road, which then means the policy was inflated and the agent did in fact design it for more commission versus cash value growth like it was supposed to be. And there's a fourth allegation, and the allegation is that the agent had a history discipline action, meaning he screwed up in the past, he did something wrong in the past, and he did not disclose it to the proper regulatory agencies, which means he purposely withheld information that could have prevented this entire policy from being written in the first place. And lastly, there are some other complaints that the employees that actually worked for PacLife themselves also gave tax advice and estate planning advice to the Busch family, which they shouldn't have done in the first place. Again, this is all allegedly. We don't know the absolute truth until this whole thing is said and done. And there was several pieces of communication from executives in PacLife also advising in certain actions taking place on the Busch's behalf, which led Kyle Busch to go ahead and hire an attorney and start to do an investigation on his own. And here we are. So as you see, there's a lot to be said about this scandal. There's a lot to be said about this lawsuit. We do not have the final word. I want to encourage you to subscribe to this channel. Continue to watch these videos. We're going to come out with certain updates about these cases and others alike. We want to make sure that you are fully informed and that you know what you're working with. And as always, if you have any questions, reach out to myself or my team through the link in the description area of this video. Make sure you subscribe, like it, share it with a few friends, and let me know what questions you have in the comments. We'll see if we can answer them in the next video. Again, my name is Mark Cassaro. I try to make very complicated things easy to understand. Check out my other content on TikTok and Instagram, Facebook as well, even though Facebook got banned several months ago and I lost about 1 million followers. We started over from scratch. We appreciate you, and we'll see you in the next video. God bless.